I don't want to wait 30, 40 years to be a gazillionaire. I want to have my income, maybe like a portfolio of about 500,000, a million, 700,000, and have high income flowing in every single month, some even weekly. That's in dividend growth ETFs. Over 20, 30, 40 years, dividends will grow and compound. You'd be surprised at how much, a $1 million portfolio pays you a year in income from the S&P. I think the S&P is going to be the best option for somebody who was passive, but as well as active people.
We are back with another one. We got Marcos Mila joining us once again for another epic conversation. And I'm just going to say this. After our last conversation a couple weeks ago now, Marcos, we spoke all about throughout the week. One, investing right into the S&P 500 and just keeping it so simple. So I want to talk about that. And then I also want to talk about a couple of the other things that we spoke about throughout the week, from the mindset conversation that we had to an individual stock name that you actually texted me about. But let's just first dive into this S&P conversation that we were having. You've been essentially investing into the S&P 500 your entire career as an investor. You made a whole YouTube channel about just investing into the S&P 500, and it's really your portfolio's core holding. I'm on the side of saying, like, most investors should just invest into the S&P 500 if you're passive. But an active investor who really loves this deal and knows how to analyze stocks and get into the game, like yourself, you're pretty active. Why not go growth here?
Diversification. I think that's the most important thing, especially when investing, and especially when investing in any sort of S&P 500 index fund or ETF, or some people even do mutual funds as well. So diversification, the fact that in an ETF like the S&P 500, you have the benefit of diversification. And the most important thing is set it and forget it, all in one ETF, in my opinion. Solid yield. I think the average yield is about 1.3% for its dividend yield. You have diversification, solid growth of about 10.5% per year of the S&P since 1957. You have growth companies, value companies, and the top 500 companies best represent the US economy all in this one fund. So you really can't go wrong with an investment like the S&P, because you have growth, dividend growth as well. Some people don't even think that something like the S&P has dividend growth. And that's going to be super important. So in the next, 10, 20, 30, 40 years, you have your dividends and your passive income, quote unquote, grow over time. And then the dividends that are distributed from those funds, like a ETF or mutual fund, are qualified income, which makes it so you're going to be more tax efficient than something like perhaps a cover call ETF. And of course, you can have in a Roth IRA to have tax-free dividends. But in terms of one set and forget ETF or mutual fund and whatnot, I think the S&P is going to be the best option for somebody who, like I said before, was passive, but as well as active people. I know a lot of investors like to buy more heavier on the dips and maybe not trim, but maybe less on the rips, right, on the S&P. But they could do what I do as well. I complement it. I don't have just the S&P. So I guess a background on myself, I'm 24 years old, almost 25, but 24 is a good number. I feel like I'm still pretty young. And with the S&P, I guess it's not as risky as maybe going all in on a tech ETF or a pure growth play, maybe a momentum ETF, right? But I complement my VU position, which is about 70% of my whole entire portfolio, with other ETFs like a growth ETF, a more NASDAQ 100 focused ETF. I think those are great plays. I think that I'm still going to be rocking with the S&P for a while, and I could sleep well at night. And the most important thing for investors is everybody has their own strategy, right? Dividend growth, high income, S&P, maybe more individual stocks, which are perfectly fine. And from someone like myself, I feel like with individual stocks, it could be more of a time-consuming hobby or maybe a time-consuming event, right? Just to do all the research, hours of research, and the risk is going to be higher when you pick these individual names and you have to be more active versus the S&P. I could just relax, sleep well at night, make YouTube videos, talk to you, Ari, hopefully have some good growth long term.
Where's your portfolio at these days?
I think I just checked, and on Friday, if you include, I have a small private investment in it's a public app. I'm gonna wink at it. I don't know if I can disclose it, but my portfolio without that is at about $195,000, and with that investment, it's just over $200,000 in investments.
And the vast majority of that came from the S&P, basically, throughout you and your investment career, because you only recently started to add other ETFs into the portfolio.
I have other funds that I started investing in about a year and maybe a year and some change, like a year and a half ago. But I did have Invesco has the original ETF of their NASDAQ 100 ETF. And then they released, quote unquote, the mini version of it. Before I had that fund, but it was a smaller holding. And then I sold that and switched it to the mini version of their NASDAQ 100 ETF because that smaller expense ratio that's cheaper definitely makes a bigger, I guess, mental difference, but also saves you a ton on fees long term.
It's funny. First of all, a heck of a portfolio. It's funny. I had Gary Gill on, as you know, on Masters of the Market a couple weeks back, and he's a big S&P 500 guy. We, of course, spoke all about the S&P 500 and just invest in this one ETF. Like you keep saying, it's your buy and hold and forget, sleep well at night type of ETF. I feel like so many investors just have a problem with that. Especially, dividend investors, sure, because now we're talking about a dividend yield that's less than 2%. Anytime you go below 2%, I feel like, or 3% for some dividend investors, they go crazy. What the heck type of yield is that? It's nothing, can't get anything from it. I think they fail to actually see there's growth opportunity there, which is incredibly important for younger investors. I'm looking at the S&P, and I was just thinking about this before we jumped on pretty heavily. 8 out of 10 retail investors. 8 out of 10, maybe even 9 out of 10, Marcos, should just be in the S&P 500. Like what? And nothing else. What do you think about that?
I think that's a great option. I like 8 out of 10. Yeah. However, there are two other funds I like a total world ETF, where not only do you have S&P 500 exposure, but you also have international stocks. I like that a lot. Maybe even other ETF issuers have total stock market, or should I say broad market ETFs. So instead of having the S&P with only large caps, you could have mid caps, small caps, and then of course that total world type of ETF or fund has international stocks as well. So you are going to be more diversified than only the S&P. Maybe let's scale it back to like 6 out of 10, because I would say nowadays, especially in the trend we're going on this year, maybe some people should go into traditional dividend growth ETFs. I like a lot. So you could have maybe a higher yield, but still have some returns that could keep up with the S&P. And some of these dividend growth ETFs sometimes do outperform the S&P. It just depends on the ETF, if it's passively managed, if it's actively managed. But also circle back to why Gary likes the S&P. And I know he's a huge fan of Warren Buffett. So kind of the old Warren Buffett, low fees. Most of these S&P 500 ETFs have low fees. Diversification, risk is going to be lower compared to growth ETFs, maybe even your hyper tech ETFs, right? And of course, it's going to be that set and forget it, sleep well at night. Let the economy, let the free market determine the market caps of these firms. Let them do their thing, grow their revenue, grow their profits, and you're just going to be sitting back, relaxing, and hopefully have a ton of money in your portfolio. But I also thought of an analogy of why people don't think the S&P is the only way to go for just one ETF. And it's kind of like, I'm a car guy, right? I love Lamborghinis, Ferraris, McLarens. I used to go to a lot of car meets, and now they have basically a full-time channel. It's scaled back a lot. But when you think about these car guys, they buy a Lamborghini, right? Stock from the factory. And that's kind of what you're getting with the S&P. Lamborghinis are fast. They look cool. They provide, that feeling of, wealth, right? With the S&P, it's kind of the same thing. You're buying it and you're knowing that in 10, 20, 30, 40 years, you're going to hopefully have a great return, feel wealthy, and it's going to have some great returns. It's maybe not it's kind of sexy, right? Then these car guys, they buy the Lamborghini and then they put on different wheels, exhausts, tunes, wraps, and all these modifications to the car to make it maybe faster, more appealing, fit their goals and their own personal needs, kind of like their own personality and character. And that's the same thing with portfolios, right? People buy something like the S&P, and then they add in a little bit of growth, add in a little bit of dividend growth, add in cover calls, leverage ETFs, and it fits their overall personality and portfolio. And that's kind of like how I think of it with cars and some car guys with exotic cars, at least.
How much should the S&P be weighted in someone's portfolio? Because Gary and I were also speaking about this. Gary was, of course, like way over the deep end. I'm like, no, just the S&P, just the S&P. I'm a big fan, though. It's probably because how I started off investing, and then just to where I'm at now. Like I call it my foundation. So layer one is the S&P. It's the biggest foundation in the portfolio. And then on top of that, there's actually another ETF. It's a tech-oriented ETF. And then I have my individual stocks. And the S&P, I believe right now accounts for about 32% of my portfolio. And then from there, I got 31% in the tech ETF, and then so on and so forth. But I'm a huge fan, first of all, of definitely being overweighted in a solid foundational ETF like the S&P 500. Because I can never fail with that. Gary was like, no, everybody should just be like 90, maybe 95, like just over the top. And I can see, where that point becomes valid, because we can see it as creators who are just in this space and talking about finances and investing all the time. How many times do you speak to someone and like they lost all their money because they invested in things they have no idea what they're investing in? They get spooked out by volatility. And you could just be like, man, go 100%, 100% in the S&P and never worry again.
Do you remember that story I told you when we were in the exchange conference about that one girl who was like emailing me and DMing me, and she had a portfolio and it was mostly S&P, and then over time it started getting like more growth, more tech, more individual stocks, less S&P, crypto, and then meme coin crypto. And then it
Bankrupt.
blew up in her face. And then when I was trying to tell her like how to actually invest, she blocked me or whatever. That's besides the point. I just want to show you like some interesting stories I have. But in terms of the allocations, it should be the majority of a portfolio if you are looking for growth. One thing I've learned about being a YouTuber and a creator is that not everybody has the same goals as me. Some people want more income, more dividend growth.
Let's like stop right there. What's your goal? Because I'll share mine, and I want to hear yours, just so everyone knows like what we're even talking about here with goals.
Capital appreciation, whether it's tracking the market or maybe just slightly beating it, because I do have about maybe 30% or 25% of my portfolio is about growth and tech. So it depends on the beta. So my betas are running around like 1.08, a little bit more volatile, a little bit more of a higher touch, more riskier than the S&P. But I've been tracking my portfolio and it's just been barely going above the S&P on a bull market. But during those times when markets do kind of cool down and calm, I have 5% of my portfolio in Charles Schwab's dividend ETF, their famous one. And iShares does have a solid growth ETF for dividends. 5% does nothing in a down market. That the dividends are super low. So the goal is long-term capital appreciation for me, despite having a 1.4% yield last time I checked. So mostly growth.
Do you want to retire early? Like, is that in the plans at all?
I get that question a lot, especially from girls. Because girls know, like, go out, date here and there, or my friends too, from college or whatnot, and they're like, you work so much, and they can kind of see my face, right? I don't know. I like working. I feel like there's a purpose. I'm fulfilled by working. Maybe I get some sort of dopamine hit from working, but it's different because I feel like my work isn't work sometimes, right? So in terms of age, 65 I would be lying if I want to tell you, I want to retire by 65. I would say maybe scale back, maybe my mid 50s. My dad's 53 and he's working, like he's excited to work, boom, 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 wants to do his thing. He's always has these like goals. And we were talking about climbing. You see a mountain and you climb it. And then you get there, you just sit there, you kind of look around, and there's a new mountain to climb. And then you're just like, I got to go after that one. And then you climb that one. And then the same thing kind of happens over and over. So at a certain point, you have to understand where maybe the climbing that next mountain maybe might not be worth the fulfillment that I thought it would be from the last mountain. So at a certain point, maybe it's a good time to enjoy the view, enjoy what you have, share with others. And for me, I feel like maybe quote unquote, not that I'm retiring every day, but that every day I'm feeling some sort of fulfillment and excitement to do what I got to do, which is, work in the finance industry, invest, talk to investors, make content for investors. And honestly, it's a great opportunity.
When I think about a lot of the community members, especially that are following me, heavily into dividends, and I am also into dividends, and used to be, I think, a lot more, hence the channel and the community that I've built. But over time, a lot of beautiful learned lessons throughout my experience. And what I've realized is a lot of investors who are stoked about dividends and dividend investing or retiring early even want to start to build that passive income stream. And my goal, capital appreciation, as you shared, over the course of the long term. Now I'm going to throw this out there. I have a crazy goal set for like the remainder of this year and into next year, which I'm just outright going to say it. I want $1 million portfolio, by the end of next year. That's a very audacious goal. In my mind, it just makes sense that you would want to hit, the 7-figure club as fast as possible to then later on, and this is where Gary and I even really agreed, I think you'll probably agree with it too, to then at some point in the future switch courses or switch gears rather into more of a dividend yielding ETF once you get there. But my whole thing right now is like, it's important to hit 7-figure club ASAP. Get there. I'm young. Not that I'm risking like crazy. Anybody who watches my channel knows I have at this point about 7, individual stocks in there to the likes of Apple, Google, and I sold some of my heavier hitters in the dividend income world, like the realty incomes of the world. And when people ask me why, it's like, first of all, I still consider myself a dividend investor because all the stocks basically in the portfolio or ETFs pay the dividend, even if it's below the 2%. Or heck, even 1% for some of these opportunities. But it's about hitting that 7-figure club as fast as possible.
So for me, I turned 25 in November of this year. So my goal was 250,000. I think $250,000 sounds like a good number. And talking about goals, so next year I wanted about 350, 400 in the portfolio. Of course, most of that is going to be from contributions. People might be stressing themselves too much by thinking I got to be a millionaire before 30. Before 35, before 40. I got to have multiple millions of dollars to even think about retiring. And some people forget that investing is just one part of their financial picture. How you view budgeting, how do you view savings and having an emergency fund, having your view on credit cards, on your lifestyle goals, right? Investing is just one portion of it. So some people might have millions of dollars, maybe $1 million portfolio, but you don't see debt. You don't see their credit card score. You don't see what's going on behind the scenes, right? Family problems, relationships with their wives or their husbands that might wipe out half of that income. So many different things that go into it. So as an investor, there should be honestly more content about total investing or total financial goals with investing, with saving, with your relationship with money and whatnot. Also maybe a little bit of a spirituality too. But $1 million is cool. I think 2 million is better. But when I think about investing, well, I'm going to say like there have been times when I have like, bank accounts looking good, investing's looking good. And you see people at those restaurants and driving the cars and it's cool, right? But I think the feeling of financial freedom and doing whatever you want to do at a certain point is the best feeling. And I was talking about this with my dad yesterday because he was asking me like, why do people invest if they want to have millions of dollars? There's got to be a bigger end to this. And like I said, it just depends on your goals. $1 million is cool. 2 million is better, but giving back to people and sharing the wealth with others, I think is the most important thing than just having everything for yourself.
So that actually leads us, I feel like into the conversation that we had a couple of days ago. And we were talking about more of life and just like, what's not the end goal in terms of just like retiring early. Because, for me, I don't ever see myself actually retiring. I like working, I enjoy the game of business and working. I never find any of it to be troublesome or burdensome, but it's the freedom to do what you want. And I'm sure you experience it even now as a creator. And I know you're still working full time, as am I, but you have options. I think once you start to get options, and that's the real taste of freedom right there. And then the question comes down to like, and I know I asked you this, like, what do you want your tombstone to say? Marcos Mila, the guy talked about ETFs his whole life, for me, I see everything as really this means to an end where I'm like, man, even as I get older, investing into the S&P just sounds sexier to me. And I'll tell you why. Because I used to spend so much time analyzing stocks and really going, deep into the financials and like really trying to select the winners and then keeping up with the winners or keeping up with my investments. But then you realize you've just created another job for yourself. And what I like and appreciate now more than anything, after I've made, more than half my portfolio into these 2 ETFs, I bought some of my freedom back. And now what I do, what I really love doing is I do a lot of coaching on the side, sit with a lot of people for mental health, addictions, spirituality, like all that stuff. And I love it. I absolutely love it. There's a kid, I actually go to the dog. I have a dog. So every morning I go to the dog. My neighbor's son has a slight form of autism, but he loves my dog. And so I started taking him almost every day with me in the morning just to spend like an extra 30 minutes with him. And like, I feel like I bought some freedom back because my agenda's less, and then at the end of my days, it's like, what do I want that tombstone to say? Really just this guy helped maximum amount of people.
Definitely. And for me, I was kind of thinking about it while you were speaking. I
ETF
just
King.
wanted to ETF King is
Marcus
cool,
Mila,
right?
ETF King.
That's a cool like Instagram bio, but I'm gonna just probably keep it simple: father, friend, son. I think those are the three main things that I think is the most important thing to me. Family, caring about the people around me, even like a friend to my audience. I try to respond back to most comments, Instagram DMs, Blossom messages, and whatnot. And of course, hopefully one day I could be a good dad and provide. And I kind of want to go back to one of your questions. I didn't answer it, but it was about the switching from S&P to dividends investing as you get older. That's cool, but some people don't know that over 20, 30, 40 years, maybe if you've been starting to invest a little bit later, dividends will grow and compound. You'd be surprised at how much, a $2 million portfolio pays you or a $1 million portfolio pays you in a year in income from the S&P. And some people don't know that it's okay to sell shares. The reason why people invest in growth ETFs or tech ETFs, semiconductor ETFs, quantum computing ETFs, momentum ETFs is they're looking at it for capital appreciation. So if you want to get passive income from it, just sell your shares. You've held it for hopefully longer than 1 year to make it at the lower tax rate. And then you could quote unquote use those shares as dividends, as income, because you've earned it. You've got the return. You've held it through the ups and downs. So when people say, okay, I want to just invest in S&P or individual stocks or growth only, and then sell it in 40 years and then switch to income for when you're creating a taxable event. So good luck on your taxes. If it's in a Roth IRA, I could see that make more sense because you could just sell it all and then invest in those ETFs. But I think you have to hold them for longer than 5 years. Don't quote me on it before it becomes more of a tax-free event. And then you have to start maybe all over the dividend and compounding process, sort of, because you've compounded those dividends. What people should do if you want to go that growth strategy and then income over time is just don't sell those shares. Keep them maybe 5 years out, 10 years out, 15 years out. You invest in dividend growth ETFs, not cover call, because the cover call income will kind of stay flat, maybe be less, maybe be volatile. Dividend growth, in my opinion, always wins because long term, your dividends will grow, 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 grow. So when you need the income, you're like, wow, I got all this income going from a better yield on cost, and I could have better returns long term. In retirement, my income goes up every single year versus a cover call ETF or maybe even a pure growth fund. Maybe the income doesn't go as much up. I said a lot there, but when people say switching from growth to income kind of leaves a bad taste in my mouth. It just depends how you do it. And some people don't know how to do it. That makes sense.
Look, I think everybody just gets scared about, first of all, like you said, taxes. And it could be, again, I've just found that so many investors don't really know what they're doing. And so like you said, it's like, okay, so when you come around to whether it's retirement or early retirement, whatever it is, and you start to throw that verbiage around, which I've heard quite a bit, then I'd have to sell. And when you sell, you create the taxable event. So I might as well just collect dividend income. Like there's a million arguments. First of all, it's not that hard to do the calculations, and sell when you need to. But I also think it's just important to recognize, and a lot of people also said this, not only in our last video, but in Gary's conversation, mine and Gary's conversation, total return. Start talking about total return. And then Ryan and I spoke about this actually. Is it really all about total return? And yeah, I think it is. Because at the end of the day, if you're talking dividend income, that's a part of the total return. And so you could slice the pie any way you want, but it all comes down to the pie. I want to be like a part of my dream to be on that tombstone. The reason why I want to make a lot of money is actually so I can give it away, so to speak. I want to build something for kids who grew up like I grew up, so they have a place to go, and get their mind right. And that just requires a lot of money, man. And I care about this pie that I have in front of me. So I even want to talk about with you, like just skimping out on like, you don't need to go out every night of the week. It sounds like a morbid conversation, man. But it's like when you get to the end of your days, man, it's like, I just don't want to be the guy who's like on that deathbed or kind of overlooking my funeral, like floating above, right? And people are like, man, he didn't really do that much. Like he didn't really, like he kind of just lived an average life, man. That scares the crap out of me. So what I'm getting at is big pie. Like I need a big freaking pie to do some above average things.
In my opinion, total returns matter. They just do. You got income, you got share price growth. Most of the time, share price growth will outperform your income because income will be a smaller portion of that total return. And yeah, in my opinion, total returns matter. That's why you'll see a lot of people argue that growth investing or S&P 500 investing is going to be a better total return than just going in on Pepsi, Coca-Cola, maybe even realty income, maybe even those higher yielding dividend stocks, cover call ETFs that cap your upside. And that's the biggest argument is going to be total returns matter. My opinion, they do, but some stocks and ETFs, their goal is not total return. For example, like realty income, some people complain, oh, it's not going to go up like it did back then or whatnot. Well, maybe you should do the research and think that, okay, maybe realty income is just their main shareholder value return is going to come in the dividend. So in a down year, you're going to be relying on the dividend, not relying, but you're going to be getting that, what, 4%, 5%, I don't know, the yield on realty income, especially with the cover call ETFs too.
5+ right now.
5+, right? So let's say the market just tanks 10, 15%. Kind of doubt realty income will dip that much because of the business model. But you'll be knowing mentally, okay, I'm going to get a 5% return no matter if the market goes up, goes down, regardless of capital appreciation, I'll still get a 5% return no matter what happens. And some people, they sleep better at night. They feel better at night by just having that consistent income, maybe even growing income in their portfolio versus the share price risk, because more total returns is going to be higher risk. That's just how it works. So if you want to be more risk on, then great. Invest in a growth ETF, invest in an S&P 500 ETF, broader market ETFs, etc. And some people want to be more riskier. And then some people, they don't want that risk. They don't want to go all in on the S&P, individual stocks with the S&P. They want to go in high income plays like Charles Schwab's dividend ETF, like Vanguard's ETFs with dividends, all these different funds. And they just want the income first. And that's their main priority is, to get the best total returns, you have to buy and hold and compound that return 10, 20, 30, 40 years versus some of those higher income plays with a yield of about 4%, 10%, 20%, 100%. They are like, hey, I don't want to wait 30, 40 years to be a gazillionaire. I want to have my income, maybe like a portfolio of about 500,000, a million, 700,000, and have high income flowing in every single month, some even weekly, and then living off that dividend. And that just makes them happier. That's their goal. And so people can manage that goal versus 30, 40 years from now to forego that upside potential, because some of those funds, you do forego upside potential, whether it's a slower growing stock in the ETF or it's capping your upside from cover calls.
Marcos, man, I don't want to out you, but a couple days ago, man, you sent me a message, and I got to bring this up because this is totally not the S&P 500. You were talking about United Health.
Yeah. I WhatsApped Ari, and I was like, should I buy United Health? I think it's a funny story. So in college, I interned at a consulting firm in healthcare, and all these consultants, I kind of asked them, oh, what do you think about United Health? People are like, great stock. We do work with them, and it's one of our clients, and they make so much money. The insurance industry, they're describing it to me how it works because I was an intern. And then my dad is a big believer in United Health. And so we kind of going back and forth on it. And as an investor, when I see value, I keep it on my radar. I remember when American Express back in the day took like a little bit of a downturn, and I bought it and sold it within a month. I know you did that with a stock on Blossom. I saw one of your trades. It was amazing during this last tariff tantrum. People, if you just bought your Palantirs, your Nvidias, American Express and whatnot, I don't know, all these stocks were on fire sale. So if you just bought it and we're like, hey, this is a one little small dip in a huge long-term uptrend, I'm going to make money. And so you took advantage of it. I want to say, congrats on that one. What stock was it? Remind me.
Visa.
Yeah, there we go. See?
And I did it twice, by the way, because Visa went up, and then Trump. It was like, this is why I'm so big on like just putting my ears, on the news channels and like wherever I can, just to listen to what's going on out there. And if you were just the average Joe retail investor, watched the news, every time Trump came out and said something about tariffs, the market shook. Things went down. Some of the things that went down were, Visa for one of them, right? Consumer goods, and our consumers going to be spending. And so I watched first of all, I was invested in Visa. Just realizing that there's going to be a lot of turmoil, I sold Visa. Visa then went down. I bought Visa, and then it went back up on good tariff news. And then like a week later, Trump was like, forget tariffs, we're going all out. And it fell again. And then I bought it back and I sold it again. And actually now it's up. I don't have it in the portfolio anymore. But from time to time, I do that. I don't consider those risky, as you shared. It's like long term here, all these stocks are going up anyways. So let me just take a chunk of change, throw it into a Visa. So I ended up doing that twice. And then I saw that Waste Management was down. And so I threw my money into Waste Management, rode that one back up. I still hold Waste Management. That will probably be longer term, but it's worth it, man, to do it.
I guess to go back to your point, it's an idea. Even if I do it, it would probably be like $3,000, $5,000. Some people look at that stock. There's 100% upside from where it was to where it's at now. You could get that upside, or it could just fall and keep on falling, like PayPal. PayPal did the same thing. Super high flying stock. When it went down like 40%, and like people were buying it. Then it went down another 20%. They kept on buying it. And then it went down another 20%. So you're just buying the dips and you're just buying a falling knife. So I'm not saying that that's the same thing that will happen with United Health. It's just an idea, maybe to keep on my watch list. And when I get the time, I'll do the research, because I'm not just going to blindly buy. I got to look at the balance sheets.
What would it take for you to buy it?
Honestly, P's
like
pretty
we
low.
were in Vegas together, man. We were sitting with someone from the team the company that you're invested into, and we were having this conversation. You're like, I'm going in on it. Like, what is it going to take for you to get conviction on like United Health or any other stocks that are out there to actually add an individual stock to your portfolio?
Well, that was different. So I need a reassurance. So when I was doing that private investment, I was like, all right, I'm going to meet with a guy who works at the company. I'm going to kind of investigate him. What's the management like? What's the future projections? How is it your relationships with clients? What's the net income from this year? Users, right? So I understood that business model a lot more from being a YouTuber and from knowing kind of how the ETF industry works a little bit, versus for me, like United Health, I kind of know how they make money, but there's got to be a better total picture for it. Plus, I'm not a healthcare industry expert. I like tech stocks a lot more, financial stocks a lot more, maybe those dividend stocks that are kind of their buy and hold forever. So United Health is kind of one that maybe that's not my forte in the sectors of the market. I would probably have to be at a screaming price, where right now it is, but you also have to think about too, where some stocks are kind of correlated to the market. So if the market just falls, let's say, go back to tariff tantrums, like 10%, 20%, then United Health is probably going to fall too, more, because that is how it works. Most of the stocks with the index, and they're kind of correlated to that news in the economy. So if the economy is going to go down, fears of inflation ticks up, interest rates go up, stocks might move that way until earnings come out, right? But maybe you have to wait till another earnings report, new CEO came in, and some people don't know that you could always buy on an uptrend. Let's say the stock's at $300 and you're on the edge. You want to buy, you don't want to buy it. Wait till earnings come out. Wait till that next earnings call. See what they did different from the last quarter. And let's say the stock went from 300 to 350 by that time. There's still, I'm going to do the math, like 80% upside. So you could just buy on the uptrend with confirmation of better news and a better outlook, versus right now with the huge turmoil of United Health. So that's just how it works with investing. And it was cool with that investment because I felt like an active investor, kind of like Bill Ackman, if you will, sort of, kind of going in, getting an inside scoop, and then buying my shares and whatnot. For now, it's an idea. And, I'd rather buy, if an Apple or Microsoft or NVIDIA did that, I would have bought it. But because it's United Health and it's not my forte, it's just on the watch list for now.
Look, so many people have been messaging me about United Health specifically. It's what I call the biggest loser in my portfolio right now. Yeah. But you know what, man? I'm not, first of all, understanding their business model, but then also understanding, I think what's more important about United Health is what was going on versus what this transition. So as you mentioned, the CEO stepped down, their last CEO, and actually stepping into that role is Stephen Hemsley, who a lot of people don't recognize this because the news hasn't really been pitching it. We keep saying the new CEO. Stephen Hemsley was the CEO who led United Health to where it was before Andrew Whitty took over. And I think it's really important to understand because he was like the revenue generating machine for United Health. And right off the bat, the first move, which I really like, when you want to bet on a CEO, the CEO's got to, for me at least, bet on the company. Right off the bat, Stephen Hemsley steps back into the role of CEO and he buys a ton of stock in United Health, which shows his conviction in the company. And, I think just understanding like the amount of, whether it's Medicaid fraud, that's in the news, the headlines. Like United Health for a long time, months, couldn't escape negative news headlines. And so I think you just have this stock that's just been beaten down and beaten down and beaten down. And then just before Whitty stepped down, the company decided not to proceed with projections, which that's where we saw that precipitous drop. But I'm a bull on United Health long term, and knowing I'm not going to sell it for like 20, 15, 20 years, whatever, unless something crazy happens. Like I can't say I'm not ever going to sell it for 15, 20 years. Something could happen. Long story short here, it's just like United Health play for me is gold. I'm holding strong, high conviction in it. I think we got to give it time for Hemsley, first of all, to get back into business, get United Health back into gear. I think it also has to just get out of the negative news headlines. That's a killer. To mention what you shared, we got to start to see at least, I want to say 2 to 3 earnings seasons where United Health shows what's really under the hood.
I think you said it way better than I could. And I also think that it could be $1,000 stock in the next 15, 10 years. Just depends. But you'll definitely see huge moves to the upside with good earnings reports, with positive news and positive sentiment. Maybe United Health is kind of like Netflix, where at one point, I believe last year, there was declining user growth. They kind of felt like they capped that growth, and then the stock fell like 30, 40%. And then people were saying Netflix, the growth story is gone, reached as much market cap or users as they can, and then rebounds, and it's back to normal. Business is back to normal. So maybe we can see the same for United Health. Just depends. I like your analysis. 2 earnings reports, what's under the hood, and then maybe after that you could confirm a buy on United Health. Or maybe what you can do is, let's say you have a money for a position, you can maybe start small now, and then you can maybe buy again on the upside or at a higher price where there's more confirmation, versus just thinking, it's like, should I buy it now or should I buy it later? Some people should, let's say you go in with a 20% position of your money, and then if it dips down, you have another 20% buy. And then if it dips down again, you have more money. Or if it goes up, great. You could just buy an uptrend, right? Average it out. So the average will be way lower than if you waited those 2, 3, 4 months to buy at the high, if United Health has great earnings reports. So there's definitely ways to play this stock from a strategy perspective, but long term, I think it's a great stock.
100%. And look, at the end of the day, let me ask you this, man. Your biggest takeaway from this S&P conversation, or this conversation in general?
I got to make a lot of money to hopefully give back. I think that's the best thing.
Grow the pie.
Grow the pie. Sticking with the S&P with other ETFs is great, but talking about making money with ETFs, making money with stocks, and analyzing them. But I think the bigger picture is still like how you come off to other people. Good father, or giving a good mother, if you're watching this, good son, daughter, friend, and making money to where you're financially free, or you have the means to do good, whether it's giving to others, donating to a good charity or a church or whatnot, maybe even starting something like you said, which I would like to say, it costs a lot of money to do a charity or whatever you want to do that's a greater good, but there's a big tax offset. So that's kind of a good maybe food for thought from a business perspective, is there's a good tax offset in that. But yeah, man, just sticking with the S&P, not overthinking investing, and everybody has their own goals, needs, and whatnot. So do what you want. If it's dividends, if it's high income, if it's growth, if it's S&P, I'm sure if you just stick with your strategy, drip dividends, stay long-term, dollar cost average, you'll do just fine.
Keep it simple. Be smart. on your investment moves. Think long term, grow your pie. Investors, we want to know what you think about the S&P 500 strategy. I want to know personally how much weight it takes up in your portfolio. So let us know down there in the comments. Of course, let us know what you think about this conversation. Marcos, it's always been an honor and a privilege, pleasure to have you on. And until the next go round, which I know will be quite soon, we'll catch you guys all in the next one.